Welcome to Higgins Capital's presentation on demystifying high-yield bonds, a retirement refresher on junk bonds. Today we're going to dive into the exciting world of high-yield bonds, also known as junk bonds. These financial instruments have a certain allure, especially for retirees looking to maintain a competitive edge in their investment portfolios. They're called high-yield bonds for a reason. They offer higher interest rates compared to other fixed-income options like government and corporate bonds. This potential for elevated returns makes them an intriguing choice for investors seeking a balance between risk and reward. Now, it's important to remember that with higher reward comes heightened risk, but that's a topic for later. For now, let's just say that high-yield bonds can add a dash of spice to an otherwise bland investment stew. Now that we have a basic understanding of high-yield bonds, let's delve deeper into their risk profiles. High-yield bonds, often referred to as junk bonds, carry a higher risk compared to other bonds, but with that risk comes the potential for higher returns. Now let's delve a bit deeper into what these risks entail. First up, we have credit risk. This is the risk that the issuer of the bond may default on their obligations, leaving investors in the lurch. High-yield bonds are issued by companies with lower credit ratings, making them more susceptible to default. However, it's important to note that not all high-yield bonds are created equal. Some have a higher credit risk than others, and this is reflected in the yield. The higher the yield, the higher the credit risk. Next, we have interest rate risk. This is the risk that the value of the bond will decrease due to changes in interest rates. When interest rates rise, bond prices fall, and vice versa. High-yield bonds are particularly sensitive to interest rate fluctuations due to their longer durations and higher yields. This can result in significant price volatility. Now you might be wondering, why would anyone want to invest in high-yield bonds given these risks? Well, the answer lies in the potential for higher returns. High-yield bonds offer higher yields compared to other bonds, making them an attractive option for income generation. They can also provide diversification benefits, helping to spread risk across a portfolio. However, it's important to approach high-yield bonds with caution. They're not suitable for everyone. Investors need to have a high risk tolerance and a long-term investment horizon. They also need to be comfortable with the possibility of losing some or all of their investment. So, high-yield bonds can be a lucrative investment, but they're not without their risks. It's crucial to manage these risks effectively. This involves diversifying your portfolio, staying informed about market trends, and seeking professional advice when needed. Remember, investing is not a sprint, it's a marathon. Patience and diligence are key. A key aspect to consider when investing in high-yield bonds is the credit rating of the issuer. Let's dive into the world of credit ratings. These ratings, assigned by agencies like Standard & Poor's, Moody's, and Fitch, provide a measure of credit risk. They're akin to a school report card for lenders, assessing the ability of a bond issuer to meet its debt obligations. The scale ranges from A to A, the highest grade, indicating a low risk of default, to D, a grade reserved for issuers that have already defaulted. High-yield bonds typically fall into the BB, or lower category, which means they carry a higher risk of default, but also offer higher potential returns. Now let's talk about the issuers. High-yield bonds can be issued by a variety of entities, including corporations, municipalities, and even countries. Corporate issuers are often companies looking to finance growth or debt restructuring. These companies might be in a transitional phase or operate in industries facing economic challenges. They offer high-yield bonds to attract investors who are willing to take on more risk for the promise of higher returns. Municipal issuers, on the other hand, are typically local government entities seeking to fund public projects. These bonds can also fall into the high-yield category if the municipality has a lower credit rating. Finally, we have sovereign issuers, countries issuing bonds. These are often emerging market countries with less stable economies, making their bonds riskier but also potentially more rewarding. The type of issuer and their credit rating play a significant role in determining the risk and potential return of a high-yield bond. A bond from a BB-rated corporation in a volatile industry will have a different risk-return profile than a bond from a BB-rated municipality funding a stable public project. To navigate these risks, diversification is a strategy that many investors employ. By spreading investments across different issuers and sectors, one can mitigate some of the risks associated with high-yield bonds. Diversification is a key strategy when investing in high-yield bonds. Just like how a balanced diet contributes to a healthier life, diversification contributes to a healthier portfolio. It's about spreading your investments across a range of bonds to manage risk and potential returns. So, How does diversification help manage the risks associated with high-yield bonds? Well, high-yield bonds, also known as junk bonds, are often issued by companies with less than stellar credit ratings. This makes them riskier than investment-grade bonds, but they offer higher potential returns to compensate for this risk. By diversifying your high-yield bond investments, you're not putting all your eggs in one basket. If one bond performs poorly, the impact on your overall portfolio is lessened. Now let's dive a bit deeper into diversification strategies in high-yield bond portfolios. One strategy is to diversify across different sectors. For instance, you could invest in high-yield bonds from the technology sector, the healthcare sector, and the energy sector. This way, if one sector is hit hard, your other investments can help balance out the losses. Another strategy is to diversify across different geographical regions. High-yield bonds are not exclusive to the United States. They are issued by companies all over the world. By investing in bonds from different countries and regions, you can spread your risk even further. But diversification isn't just about managing risk. It also contributes to income generation in retirement portfolios. High-yield bonds, with their higher interest rates, can provide a steady stream of income. And when you diversify, you're not reliant on a single bond or a single sector for this income. This can provide you with a more stable and reliable income stream in retirement. Diversification can be a useful tool, but it's not the only strategy to consider. Let's look at how high-yield bonds compare to other fixed income options in a low-rate environment. In a low-rate environment, high-yield bonds can offer attractive returns compared to other fixed income options. Let's take a moment to compare these options and discuss the potential benefits and risks of each. First, let's consider traditional bonds. These are seen as safe, reliable investments, often offering fixed interest payments and the return of principal at maturity. However, in a low-interest rate environment, the returns on traditional bonds can be quite modest. On the other hand, high-yield bonds, often referred to as junk bonds, typically offer higher interest payments as they are issued by companies with lower credit ratings. The risk of default is higher, but so too is the potential return. For savvy investors willing to navigate this risk, high-yield bonds can be a rewarding addition to their portfolio. Next, let's look at corporate bonds. These are issued by corporations to fund operations or growth initiatives. While generally considered safer than high-yield bonds, corporate bonds still carry a level of risk, particularly if the issuing company falls on hard times. However, they also typically offer higher returns than government bonds. We also have municipal bonds issued by local governments to fund public projects. These bonds are often exempt from federal taxes, and sometimes state and local taxes as well, making them particularly attractive to investors in high tax brackets. Lastly, there are international bonds. These bonds are issued by foreign governments or corporations. They offer the potential for higher returns, but also carry increased risk due to currency fluctuations and political instability. While high-yield bonds can offer elevated yields and potential for capital preservation, they should be considered as part of a balanced retirement portfolio. It's important to remember that diversification is key. By spreading investments across a range of fixed income options, investors can help to mitigate risk and ensure a steady stream of income throughout their retirement. High-yield bonds can play a significant role in a retirement portfolio. As we've discussed, these bonds, often referred to as junk bonds, offer potential for higher returns compared to other fixed income options. They do come with elevated risks, but understanding the credit ratings and issuer types can help you navigate these waters. Diversification is a key strategy when investing in high-yield bonds. By spreading your investments across different sectors and geographies, you can potentially mitigate some of the risks associated with individual bonds. Remember, in a low-rate environment, high-yield bonds can provide an attractive income stream for retirees. However, they're not a one-size-fits-all solution. It's important to consider your personal risk tolerance, financial goals, and the overall balance of your retirement portfolio. We hope this presentation has helped demystify high-yield bonds and highlighted their potential role in achieving financial well-being in retirement.